Welcome to Key Points for September. This month, why we think the US-China trade war is coming to a head, our view on what appears to be a race to the bottom in terms of central bank interest rates, and why we think there could be a window of opportunity for stocks. Now, turning to our first point, August has certainly been a hot month for the US-China trade war. The month kicked off with the US announcing additional tariffs on the $300 billion of goods that hadn't been included so far, and a few weeks later, the Chinese retaliated with additional tariffs themselves. And on the same day, the US upped the ante again by announcing additional 5% tariffs on all Chinese goods. Clearly, this situation is getting more difficult, and we see this as potentially both sides getting somewhat jittery as they know these additional tariffs are really going to impact their domestic economies. The good news is that both sides are still talking with additional meetings scheduled, and although we don't think that these tariffs are going to be unwound, there is a good chance those scheduled for October and December could be postponed or pushed back a little bit at least. The reality, however, is that with these global economic superpowers, there are going to be frictions in terms of economic conditions and in terms of technology in the years to come. And this is something I think that we're just going to have to live with. There's going to be additional frictions in the longer term. Now, turning to our second point, we said last month that more central banks were cutting interest rates as growth weakened and inflation remained extremely benign. And that indeed is continuing. Of the 44 central banks that we actively cover, around 50% have now cut interest rates in the last 3 months. And we think this is a trend that's going to continue into the end of the year. Most, timely will be the September meeting by the Federal Reserve, where we expect an additional 25 basis point cut. And importantly, when the ECB meet, we suspect they will cut interest rates by another 10 basis points further into negative territory, tiering these rates for the banks and potentially announcing additional quantitative easing. Now, we clearly think this is a good dynamic that's taking place because growth we still think will continue to decline and inflation pressures are modest. But remember, this will take time to feed into the real economy. So we still think that slowdown trajectory will continue for the time being, but at least there's a reasonable response coming through. Now, turning to our third point, safe haven assets have been doing pretty well recently given the geopolitical risks and the slowing growth that we've seen. The inversion of the yield curve has spooked investors, bond yields have plunged to new lows, commodity prices, certainly gold prices, have done well, and of course we think that some of the safe haven currencies have also been in demand. Now, in the short term, we think this could change. Stocks have become unloved, flows have been coming out of them, investors have been lightly positioned. And given that liquidity that I spoke about earlier, we suspect that stocks could have a bit of a pop in the short term, even although ultimately we think the downtrack will continue as we get into the end of this year, next year, as economic growth slows. Remember, for full details, please visit zurich.com/MSME.